Ladies and gentlemen, good day and welcome to Bazaar Style Retail Limited Q2 and H1 FY26 earnings conference call, hosted by Phillip Capital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ritu Chauhan from Phillip Capital India Private Limited. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Phillip Capital Private Client Group, I welcome all of you to the Q2 H1 FY26 earnings conference call of Bazaar Style Retail Limited. Today from the management, we have Mr. Shreyansh Surana, Managing Director, Mr. Nitin Singhania, Chief Financial Officer. The management will be sharing the key operating and financial highlights for the quarter and half year ended 30th September 2025, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon company's beliefs, opinions, and expectations as of today. These statements are not a guarantee of company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect developments that occur after a statement is made. I now hand over the conference call to Mr. Shreyansh Surana for his opening remarks. Over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today. Our investor presentation has been uploaded on Stock Exchange and on our website, and I hope you had a chance to review it. Let me take you through the key highlights of our business performance, the initiatives driving our growth, and the broader retail environment that continues to support our journey. The second quarter saw a strong demand uptick aided by the early arrival of festival season, which is a key consumption period in our core market. Our regional leadership in the under-penetrated eastern region continues to strengthen as a customer increasingly gravitate towards branded value fashion. Our wide product portfolio serves the entire family, driving higher footfalls and improved basket sizes. While festival timing can create some quarterly variation given our geographical mix as we expand into newer clusters and states, this impact will gradually even out, providing a more balanced growth trajectory throughout the year. I am pleased to share that we have delivered another quarter of strong performance, continuing our healthy growth momentum. Q2 FY26 marked a milestone period for us with our highest ever quarterly and half-yearly revenue and operating metrics across key parameters along with profit growth. Starting with the financial performance, in Q2 FY26, revenue from operational grew 71% year-on-year to 532 crores, supported by strong growth across both our core and focus markets. EBITDA rose 184% year-on-year to 69 crores, reflecting improved operational efficiency and disciplined cost management. Coming to some noteworthy operating metrics, during the quarter, our core market grew 70% year-on-year, while focus recorded 77% growth, underscoring the broad-based strength of our brand and execution strategy. We are well on track to meet our new store opening guidance, having achieved 72% of our FY26 target with 36 net stores added in the first half. We are in guidance with the growth of 40 to 50 stores for this fiscal year. Our total retail area now stands at 2.3 million square feet, a 38% increase over last year, reinforcing our growth trajectory in the retail landscape. The growth traction continued in our private label sales, which grew 119% year-on-year in Q2 FY26 and contributed to 58% of overall sales. Our sales per square feet saw a strong 22% uptick to 865 in Q2 FY26 from 708 in the previous quarter. Importantly, our inventory days saw a decline from 108 days in Q2 FY25 to 86 days in Q2 FY26, underscoring our decision to invest in technology to streamline our operations. On the back of this visibility and a strong H1 FY26, we are revising our top-line growth guidance for FY26 from 25 to 30%. Our pre-Ind AS EBITDA margin is guided at 7 to 8% and pre-Ind AS PAT margin at 3 to 4%. Ind AS EBITDA is guided at 14 to 15% and Ind AS PAT margin without exceptional gain will be between 2 to 3%. reflecting continued operational discipline and improving cost absorption. We are on track with our expansion plan. We reaffirm our target of opening 40 to 50 stores this year, reinforcing our confidence in the scalability and profitability of our model. Before we move to the discussion on the operational aspect of the business, we would like to highlight that we have undertaken a strategic reassessment of our lease term under Ind AS 116 to better align with our evolving store portfolio and expansion strategy. As a result, we recognize a one-time exceptional gain of 55 crore, which has been disclosed separately in the financials. Going forward, this will help in reducing the gap between the pre-Ind AS and Ind AS profitability. We have provided detailed information on this adjustment in the investor presentation, including the pre-Ind AS financials. In the interest of time, we will be happy to take up any specific queries relating to this separately on a one-on-one basis after this call. Please get in touch with our IR team for this. On the business update, let me begin with our progress on some of our key pillars that will have identified to propel our future growth. On digital transformation, we are making significantly headway in our digital and warehouse transformation journey with a planned investment of 20-25 crore this year towards building an integrated and intelligent technology backbone. The implementation of SAP for enterprise resource planning expected to go live in the next 6 months, enabling real-time data-driven decision-making across functions. Alongside this, we are deploying Info for warehouse management, integrating the gold rate-based advanced replenishment solution, and Domo for business intelligence and analytics. Together, this system will streamline processes, enhances supply chain visibility, and optimize inventory turnaround, laying the foundation for a future-ready, scalable organization. Moving to the merchandising, which continues to remain one of the strongest pillars of our business. Over the past few quarters, we have significantly strengthened our team by bringing in experienced professionals from leading retailer and apparel companies. This infusion of talent in the overall retail environment in India remains highly supportive of our growth strategy. Tier 2 and Tier 3 market continues to lead the consumption momentum driven by rising disposable income, aspirational lifestyle, and a clear shift from unorganized to organized retail. Simultaneously, Tier 1 markets are witnessing strong participation from younger value-conscious consumers who seek both affordability and style. Despite global macro uncertainties, domestic consumptions remain resilient, with customers increasingly prioritizing the quality, experience, and value, a space where Bazaar style is naturally positioned as a leader. When we look at the broader retail landscape, the value segment in India is still at the nascent stage with enormous untapped potential. Unlike developed markets such as the US or Europe, where one or two large players dominate the space, India currently lacks a single national value retail leader. This creates a wide and open opportunity, and Bazaar style aims to fill this wide space. We believe India's consumption story will be value retailer driven, and our proposition, Style for the Entire Day is ₹1,000, captures that essence perfectly. It's an offering that combines aspiration with affordability, and this positioning has connected powerfully with the consumer across our market. Now coming to the operational parameter, same-store sale growth stood at 22% in Q2 FY26 and 10% in H1 FY26. Private label contribution was 58% in Q2 FY26 versus 45% in Q2 FY25 and 59% in H1 FY26 versus 48% in H1 FY25. Total store count reached 250 in Q2 FY26, up 36% year-on-year. Retail area now stands at 2.3 million square feet, a 38% increase from last year. Focus market performed well, with Q2 FY26 revenue at 71 crores, up 77% year-on-year, and H1 FY26 revenue stood at 144 crores, up 75% from the last year. Average transaction value for Q2 FY26 stands at 1,005 and 958 in H1 FY26. Number of bills grew 69% year-on-year to 5.63 million in Q2 FY26 and 58% year-on-year to 10.11 million in H1 FY26. Quantities sold increased 63% to 19.5 million units in Q2 FY26 and increased 55% to 34.57 million units in H1 FY26. Sales per square feet stood at 865 in Q2 FY26, up 22% year-on-year, and 768 in H1 FY26, up 12% from last year. Inventory days for the quarter reduced to 86 from 108 days, while trade payable days stood at 70 compared to 81 for the same period last year. As a value retailer with strong presence in Eastern India, our demand is seasonal and influenced by regional festivities. Hence, our performance is based view on a full year basis. We remain in an expansion phase, investing in new store and digital capabilities. While this investment may temporarily affect operating margins, absolute growth continues to be strong. Revenue for Q2 FY26 stood at 532 crores, reflecting a strong 70% year-on-year and 41% quarter-on-quarter. Gross profit for the quarter increased to 162 crore, representing a robust rise of 76% year-on-year and 20% sequentially. Gross margin remains healthy at 31%, expanding by nearly 90 bips on a year-on-year basis. For the first half of FY26, our revenue stood at 910 crores, reflecting a strong growth of 55% over the previous year. Gross profit for the period increased to 298 crore, registering a healthy year-on-year growth of 63%. On the expenses front, manpower cost increased by 40% year-on-year, primarily driven by our ongoing expansion initiatives and the addition of senior leadership talent. Moving on, our Ind-AS EBITDA for Q2 FY26 stood at 69 crore, reflecting a robust growth of 184% year-on-year and 19% quarter-on-quarter. On a half-yearly basis, EBITDA rose by 92% year-on-year to 127 crores. On pre-Ind-AS EBITDA for Q2 FY26 stood at 33 crores, reflecting a robust growth of 933% year-on-year and 33% quarter-on-quarter. On a half-yearly basis, EBITDA rose by 132% year-on-year to 58 crores. To sum up, Bazaar Style is firing on all cylinders. Our differentiated value proposition, disciplined expansion model, accelerating digital transformation, and strong operating leverage. We are building a future-ready, scalable, and profitable retail business positioned at the heart of India's consumption story. Thank you for your continued trust and support. With that, I will conclude my opening remarks and request the moderator to open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gaurav Jogani from JM Financial. Please go ahead.
Hi, thank you for taking my question and congratulations on a strong set of revenue growth numbers. My first question, is with regards to your guidance of, revising it to 25 to 30% for the year. Now, even if I take the higher end of the guidance at 30%, that would mean that, H2 revenue growth would be somewhere in the range of around 16% only. So just wanted to have your thoughts on the same, that do we expect a significant deceleration in H2 to have the guidance of 30%?
So yeah, obviously the Q3, though I think Durga Puja is a significant cultural and commercial event in the Eastern India, but I think our business model is not reliant on it. But again, Durga Puja plays a very important role for us. So Q2 becomes a bigger quarter across all the quarters. But while saying that, I think we have grown at a 55% year on year, and the guidance that we have revised from 25 to 2030 is, again, as I said, we have a conservative approach towards the revenue. We target more, but try to achieve the numbers that we say. So 30% is the guidance. I think mathematically what you are saying is correct, but I hope we'll be able to achieve 30% revenue.
Okay. And sorry, I missed out on the guidance that you also revised for the pre-Ind AS margins, both the pre-Ind AS EBITDA and the PAT margins for the year. If you can just reiterate that.
So we have not revised the guidance. We have said key on the Ind AS because the PAT with the exceptional gain, it will be more. So without exceptional gain, the PAT for Ind AS is between 2 to 3% only. So we have not revised the guidance for PAT or EBITDA, but the guidance has been revised only for the revenue.
Okay. And have you given the number for the EBITDA also, the reported EBITDA margin, what you are looking out? The reason for asking this is, if we look at your gross margins also, your gross margins for H1 has expanded by 150 bits. So how should one look at the gross margins here?
So the gross margin for the entire year, as we have already communicated in the earlier call, it will be 50 pips only. Because there Q4 there will be another USS of winter. So the margin will be around 34% overall.
So for the full financial year, it will be a 50 pips increase.
50, right? Okay. And apart from this, we have seen this rent per square feet, increasing sharply, around approximately 20% for H1. And I think you have also highlighted that, you'll be spending 20 to 25 crores towards tech and all. So two parts to this. One, the tech cost, would it be capitalized or would it be taken to the P&L? And also on the rent per square feet.
So in terms of rent per square feet, as I've also already mentioned in the earlier calls, it depends on the tier that you are opening the stores in. So for us, 56 to 57 rupees is the annual rental per square feet for this entire year. In terms of per square feet rental that we are going to charge on the PLL. And in terms of capital expenditure on the tech, so again it's divided into two parts. So for example, SAP will be implemented and will be live by next year. So the cost of SAP will be capitalized, but as N4 will be live, I believe by 1st January. So the cost will be hitting to the PNL. So it will depend. Domo will be live by December 1st week itself. So the cost will be on the PNL. So it will depend on the tech to tech, and when is the implementation, and will it will get live in which period.
But so would it be hitting, because your capex for H1 has already been, I think, around near 80 crores odd. So does this increase your capex for the year? How much capex are you anticipating for the year?
So our plan is to have around 100 crores as a total capex throughout the year, and as we have already opened more than 36 stores in the first half, I think, and our target is to open between 40 to 50 stores. So for the balance 6 months, the 20 crores is the planned capex that we have in our mind.
Okay, sure. So I'll come back into the queue for more questions. Thank you.
Thank you. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations on results.
Sorry to interrupt, Palash. Your voice is muffled.
Yeah, is it okay now? Hello?
Yeah, it's better
Go
now.
ahead.
Yeah. So, sir, my first question is on inventory. So, inventory has came down. Do you expect this to go, like this trend to go further and inventory to come down in terms of number of days?
Yeah, so for the September, as the plan that we have in our mind, we have been able to execute, and as a result, you can see that the inventory per square feet is reduced by 246 rupees from last year, and I believe that the ARS system and the thing that we are implementing on the tech side, we are working on reducing it further. So you will see that expecting the 31st March also.
Okay. And so, what can we expect on the PAT side, on reported PAT side for next year, FY27? Do you expect it to go towards 4-5%?
So the target for FY26 is between 4 to 5%, the PAT.
Okay.
On the pre-Ind AS, on the pre-Ind AS. On the pre-Ind AS.
Yeah. But sir, now that you reassessed your leases, won't that difference between pre-Ind AS and post-Ind AS, which used to be very large, would come down and yeah?
So, it will reduce, but the impact of Ind AS adjustment will persist. It will be substantially lower, you can say that it will be only the difference that I believe from the next year, it will be only 10% of the difference between both pre and post as a profitability difference.
Okay, sir. That's really helpful. And sir, just one more question. How many stores are in pipeline? And again, the same question as last participant. Are we being very conservative in terms of growth? Because even if I look at your inventory levels, year on year, that have grown by 25%. So, won't even at least a 20% growth be possible for H2?
See, again, I am reiterating myself that as a plan, we have taken 30% for the entire year, out of which I think the first 6 months we have achieved 55%. So from 25, I already revised guidance 30%, and because this quarter will be the big season for us, because it has got all the winter, wedding, Chhat. So I think after going this quarter only, I will be able to give that answer to you, your question. I don't want to comment something. I don't know, but I think that this is a big quarter for us. So let this quarter go. Then only I will. Next call, I will tell you the answer for this question.
Okay, sir. And how many stores are in pipeline right now?
As I said, 40 to 50 is the target for this year, and we have already opened 36 stores, and 2 has been opened in this quarter, so 38 technically. I think another 10 stores will be in pipeline for this financial year.
Okay. Yeah, that's it from my side. Thank you for your answers.
Thank you. The next question is from the line of Shreyans J from Swan Investments. Please go ahead.
Hello, can you hear me?
Yeah, you're audible.
Yeah. So my first question is, typically when you open a new store, how is the SPSF of that store? Can you explain the ramp-up time a new store takes to reach the matured store? I mean, I'm just trying to understand when you open a new store, what is the typical cycle? How does the SPSF move?
So see, in terms of SPSF, it again depends on the tier that you are opening. What we have seen in last 2 years, because as a strategy, we have taken 2 approach. One is to open more stores in metro and tier 1 also, because that cities give us higher SPSF. And second, to open in the same cities where we are located. So that is also giving us a good profitability. In terms of a simple business model, if I say, so typically when a store gets open, so the financial year that it gets open, it delivers a EBITDA of 5 to 6% on an average. And when it completes 1 full year, it gives you a EBITDA of 8 to 10%. And on the maturity, which is the L12 stage, it gives you a EBITDA of 13 to 15% if you are in tier 2, tier 3, tier 4. And if you are in metro and tier 1, it gives you around 12% of EBITDA when it gets mature. All at pre-Ind AS at store level EBITDA.
How does it compare with the revenues? How much revenue does typically a new store do versus an old matured store per month or per annum? Can you help us understand?
So I think as of now we are at 92 rupees SPSF, and if I talk about the newer stores, it has yielded this year more than 9,000 rupees square feet to us because of the more stores getting opening in metro and tier 1 for this financial year.
Okay.
So it is in line with the older stores that way, you can say, in terms of SPSF.
Okay. And is there also a situation or a possibility where, say, you're opening newer stores in metros and tier 1, so those stores tend to higher revenues versus the other older stores that we would have had?
Excuse me, can you just come again with the question? Can you be a little loud because I'm not able to hear you properly?
I'm saying, have we come across a situation where, say, you're opening newer stores in tier 1 and metro cities? So, is there a possibility that newer stores tend to do higher revenues versus the older matured stores which were in tier 2 or 3?
Yeah, so a metro stores typically gives you a SPSF of more than 10,000 rupees square feet. Whereas tier 2, tier 3 gives you a SPSF of around 8,000 to 8,500 rupees typically. So the SPSF will always be higher on the metro and tier 1. Again, the rentals will also be higher on tier 1 and metro cities.
Also, in the last 1 year, how many stores out of the 36 that we've opened or 38 we've opened would be in the metro? Can you help us with the breakup?
So I can take this question offline in terms of the breakup. But yeah, overall, as I said, the average SPSF for all the stores that has been opened this year on the annualized basis is more than 9,000 square feet, which is in line with the number that we have achieved for the overall company level sales.
Got it. And my last question is, when you
Sorry to
report the
interrupt,
sales,
Shreyans. Please rejoin the queue for more questions.
this is my second question then.
We have other participants waiting for their turn. Please rejoin the queue. Thank you. The next question is from the line of Chirag from Keynote Capitals. Please go ahead.
Yes, thank you for the opportunity. Congratulations, Shreyanshi, for the good set of numbers. One thing I would like to know is the update on the insurance money which we are expected to receive due to the fire incident. Is there any update on that?
Thank you, Chirag. So on the insurance claim, as you said last call also, that we have received already the asset part, which is 3.48 crore. And in relation to the inventory, the company has submitted all the documents related to the insurance claim, and the assessment process by the insurance is in progress. We are in continuous communication with the insurer to ensure timely completion. The company is following up on the matter, and any further development will be communicated as and when they occur. We expect the decision very soon, but I don't have a fixed timeline in my hand. But I think the first part of the insurance has already been resolved, and this is the inventory part in which the discussion is going on.
As inventory part is a bigger chunk of the money, once this received, can I expect that the current run rate of stores that we have, about 40 to 50, we are going to utilize this money to increase the additional stores, or could you just let me know what are your thoughts if this money gets received, where it is going to be used?
So, the guidance will remain largely intact. We will be opening 40 to 50 stores, and the plan has been made in such a way that with the insurance money coming in, it will be used for the working capital efficiency. Because on the capex front, we are already inbuilding we are doing it with internal approvals and the banking limits. So the plan will be intact between 40 to 50. We will not be increasing the speed of store count.
Fair enough. Fair enough. Generally, Q3 are the strongest because the right. So, based on month down the line, are we seeing the same traction of growth which has been going forward?
So see, for us, because the festival of Durga Puja came in September, so obviously there has been a preponement of festival which led to a higher growth in Q2. But while saying that, Q3 remains a very strong quarter for us, both in terms of revenue and profitability. Because in our total count of 250 stores, still more than 120 stores are such which relies purely on Diwali and Chhath. And I think all the stores, including the Bengal, Assam, every store, in terms of winter, in terms of wedding, so all these things are celebrated in a manner in every state. So I think there is a good sales. In terms of winter, we are seeing a good traction. This time winter is looking good and it started well. So we are seeing a good sales coming from winter stocks, largely from across the zone. So I am expecting upcoming quarter to be a good quarter, considering all the festivals line up in this quarter.
And I'll join back with you. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah. Am I audible, sir?
Yeah, you are audible.
Yeah, okay. Thank you very much for this opportunity. So just first of clarification, next year PAT margin you said on pre-Ind AS 4 to 5%. On Ind AS, what is the expectation?
3 to 4%.
Okay, 3 to 4% on Ind AS basis. And out of this 250 stores we have, how much would be mature and how much would be new stores?
So for our section, 152 stores are mature, which is coming into L2L calculation, and balance are new and below 18 months of aging.
Okay. And in terms of depreciation, I was just reading through because of this reassessment of lease terms, we are expecting 10% increase in depreciation expense quarter on quarter. Can you throw some more light on that?
Yeah, because of the reassessment, our leasehold improvement depreciation will increase. Right. Okay. And that will be a 10% increment quarter on quarter going forward.
So 42 crores is what we did in second quarter. So we expect 10% on increase.
No, sir. So, sir, you are taking into consideration the Ind AS. I am talking about the pre-Ind AS depreciation, which will increase by 10%. Right. So it is 10 crore quarterly, so it will increase to 11 crore.
Okay, and what about Ind AS?
So Ind AS, there will be a benefit of means depreciation and interest put together. There will be a benefit of 5 crore quarter on quarter.
Okay. No, so if we take this quarter as a reference, I mean depreciation plus interest was around close to 60 crores, right? So some reference point over that. I mean, how should one look at 60 crores on Ind AS basis going forward?
Yes. So out of that, 41 crore was the interest and depreciation under Ind AS, right? And 20 crore was the depreciation under the pre-Ind AS. So if you put together, it was 61 crore. So the benefit will be 5 crore towards the depreciation and interest under Ind AS and 1 crore for expenses towards the depreciation on leasehold improvement. So ultimate benefit will be 4 crore quarter on quarter.
Okay. Understood. And just one last small thing in terms of private labels. So currently we are at about 59%. So any aspiration we have, I mean, over next 3 years, where we want to take this private labels, and what's the private label margin differential versus the other brands?
So sir, I have said in my earlier call also, our aspiration is to reach to 65% of the sales coming from private label by FY27. In terms of margin, right now we want to scale our private labels. Rather, one of our private label Square App has already touched 227 crores of revenue for first 6 months this year itself. And idea is to scale these labels. In terms of margin differentiation, as of now, we have a difference of in different private labels between 0.75 to 1.5%. But going forward, once the labels are settled in the market and people are coming to the store asking for those labels, that is the time we will again go back to the whiteboard and plan the strategy around that. As of now, the idea is to reach 65% of revenue by FY27 through private label sales, expand the private label. Every person who is coming, we want 1 article or 2 articles of private label in his or her hand, so that they can understand the quality that we are working on. And next time we can increase the quantity of those labels in the repeat purchases hand, that way.
Understood. That's very helpful, sir. That would be it from my side. Wish you all the very best. Thank you.
Thank you so much.
Thank you. The next question is from the line of Akash Jain from Money Curves Analytics. Please go ahead.
Yeah, thank you so much. I have one very basic question, sir. I have been following the company only very recently. So, as I understand, Q2 and Q4 gross margins are lower because of the end of season sale. And Q1 and Q3, there is no end of season sale, so the gross margins are higher. But when I compare to some other players in the industry, they do not show this kind of variation in quarterly gross margins. So, can you help me understand why we have such higher gross margin variation for us as compared to some of the other larger players in the industry who have quite stable gross margins across quarters?
So the main reason that is the concentration that we are having in Bengal and Assam zone. So typically entire India, the Q3 is the biggest quarter for any retailer in the garment space. But because of our presence in Bengal and Assam, in terms of the concentration that we are having, so the fluctuation in Durga Puja leads to a variation in the sales in both Q2 and Q3. So if a sale of Puja is in Q3 only, so that time you will see the numbers matching with all the national retailers. Q2 will have a lower margin because of July and August being the end of season sale. But because the Puja shifted to September, and September then becomes a festival month for us, as a result, festival buying happens, and as a result, the gross margin on the festival buying is more compared to non-festival. So as a result, the overall gross margin increases for that quarter. So this Puja shift is actually, because of that, the variation for our company is there. But as we are opening more stores in the focus market, and as the concentration between the Assam, Bengal and other regions will be growing, I will say that when the focus will grow, the balance will come in the terms of revenue that we are generating from all the states, that time I think the numbers will look similar to the national player. But as of now, till the time we have a higher concentration in these geographies, so the number will look little skewed compared to the other retailers.
So sorry sir, अगर ये दुर्गा पूजा Q3 में होती तो अपना Q2 gross margin would have been even lower than what we reported. Is that
Yes, that is what I'm saying. Because if for example in the September month, maybe we would not have sold the festival stock, resulting in the higher margins. We would have sold, or maybe some discount would have been going on in the month of September itself if Durga Puja was in October.
Understood, sir. Thank you so much. Yeah.
Thank you. The next question is from the line of Hitendra Pradhan from Maximal Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question is regarding, your corporate expenses this quarter. If you can give us the bifurcation like of your store level EBITDA margin and, your corporate expenses, or just a color on the corporate expense, and what part was due to the employees that you're hiring and, the other tech costs that you're, bearing this quarter.
So in terms of company, at the company level, our total EBITDA stands at 6.8% on pre-Ind AS, out of which the store stands at 12.83% and 6% is the HO cost for the first half of this year.
Okay, and that's your employee, for the corporate, I assume the hirings that you are doing for the supply chain and your ops, they are under the corporate expenses. So
yes, they are on the corporate expenditure.
I just want to understand, sir, your store level employee expense, has that seen a material pickup, or it is more due to your hirings under the corporate umbrella?
So I think in our employee cost overall has increased more on the corporate side comparatively than the store side. As I said, that the overall the store metrics looks good only because we have been able to achieve 12.83 at the store level EBITDA on pre-Ind AS. And if I talk about the mature stores, it has given us a EBITDA of around 14% for the first 6 months. So that is well in the range that we have planned on the store side. The corporate, as we are hiring a lot of people from the stalwarts from the industry, and considering the future plan that we have in mind, so it's the front loaded. We are just front loading the expenditure on the manpower side at the corporate level.
Got it, sir. Got it. Understood. And so my second question is related to the reassessment of the lease assets. Can you just elaborate, what was the rationale again? Because
can you just come again with the question?
Yeah, on the reassessment of the lease assets and the 55 CR that gains that you are taking onto your P&L. Can you just elaborate on what was the rationale behind it, and why did what exactly changed in terms of the lease terms? Is it to do more with the renewal, or why did you take this accounting change this quarter?
I think that there were multiple reasons to it. First thing, I think this particular system allows us to, first thing, most important thing is that there is a huge variation between Ind AS and pre-Ind AS because of the lease handling that we were doing, and we came to understand the correct approach while talking to Big Four and everyone, and then understood, and in this particular method we are assessing each lease individually after considering the business needs, store performance and market changes that are having on that store. And I think that is a very detailed list that they have prepared. And as I have mentioned earlier also, we'll be happy to address specific queries regarding this, but it will take a lot of time. I think in the interest of time, I will suggest you to have a prior appointment with the IR, with the CFO, and he will explain you that in the detail structure.
Yeah. Yes, that makes sense. Yeah, I'll join back. Thank you.
Thank you. The next question is from the line of Prashanjit Paul from 1 to 9 Wealth. Please go ahead.
Yep. Thank you for the opportunity and good afternoon, sir. My first question is, can you help me to understand what's the percentage of revenue comes from the products or apparels priced above 1,000 rupees? Any rough idea?
So, see, as a company, we don't have very large assortment. Maybe 12 to 15% of the assortment is above 1,000 range. So the percentage of sales is very lower on the 1,000 and above side, on the garment side.
Okay. Second question is, as you all know, like from 22nd September, the GST reduced from 12% to 5% for the products priced within 1,000 to 2,500. But for the garments, those are priced above 2,500. So their GST rate increased from 12% to 18%. However, while I visited many of your Style Bazaar store in and around Kolkata, so I noticed a good banner, GST Bachat Utsav. So on that banner, while I am checking that you are offering the discount of this 6.5%, even for the products, those are priced above 2,500. Like there are products 3,000, 3,500. I can understand there are very few products on those price range. But even for those products, 3,000, 3,500, you are offering the 6.5% sort of discount. But actually on those price range, GST increased from 12 to 18. So can you help me to understand your strategy here? And how is it like you're observing the GST hike, or what's your strategy regarding this GST thing?
So pre-GST scenario, so above 1,000 rupees cost sale price, we were charging 12% from the customer, right? And post GST revision, the increase happened from 1,000 to 2,500. So the GST rate reduced from 12 to 5% for this range, 1,000 to 2,500. So on that articles, we are offering discount of 6.25%, and the rest we are not charging anything from the customer.
So we thought of passing the benefit to everyone, any MRP of 1,000 rupees in our portfolio to the consumer.
Yeah, but in all of your stores, like in Kolkata, be it in Axis Mall or whatever, on the promotional banner, we can see that even for the products, those are priced at 3,000. They are also you are offering this.
Yeah, we have passed on, because that is very negligible quantity that we have in the store. So we have passed on the entire 6.25% benefit to the consumer, or across all the MRPs of 1,000 rupees.
Okay. And on the GST front itself, there is also a change of the GST in the value chain, like in fabric, all the raw material, this entire value chain. So do you think that will be beneficial for the company or not?
So see, in the broader sense, you can say, obviously, as the GST reduces, the people will have more disposable income in their hand, which will ultimately flow to the consumer section only. But yeah, it is not that it will immediately get into the supply chain. In terms of product, as we speak, it's not that the fabric, there has been tax change in the fabric side. So I don't think that each and every fabric, there are a lot of variation in the fabric structure also, where the GST rate has reduced and where there has not been any reduction or an increase of GST. So I think as of now, we have not seen any reduction in the fabric price for at least this summer season buying that we are doing. Going forward, if because of any GST rate reduction on the fabric side, if any pass on that we get from the merchandise fabric manufacturers, we will be able to pass in again to the consumer, because we don't want to increase the price. We just want to have a fair pricing for the consumer.
Okay, thank you. That's all from my side.
Thank you. The next question is from the line of Vijay Chauhan from RHPMS. Please go ahead.
Yeah, so my first question is on the consumer sentiment for the October month in terms of footfalls. So can you just elaborate and throw some light, like how we are seeing for the October month or post Q2? What's the consumer trend and sentiment? So that is my first question. Yeah.
So in terms of consumer sentiment, I think we have witnessed a positive sentiment across the zone. The only challenge was, I think, with the rain. This time the rain effect was from end of September till 15th of October, so the rain was there. But apart from that, the footfall looks good to us. As I said, the winter uptake in sale has been good as of now. We were just discussing yesterday only with the entire team. The winter looks good to us, and with the way the sales are happening, we expect a good quarter. We are expecting a good quarter this time.
So is it fair to assume the SSSG that we have reported in quarter 2, will we be able to replicate in the quarter 3, or somewhere it will be on the lower side then because of the festival shift?
I think obviously it will be subdued because of the festival shift in terms of SSG, and moreover, just to give everyone this reference, the SSG also doesn't give the clear view of any store mix, because there are a lot of stores which are not under SSG category but are under the new focus market, which has got a good sales coming in the month of October, November, December. And because our starting concentration zone was more on Bengal, Assam, so I think so SSG will be reflecting the picture of Bengal and Assam at the corporate level. So just for example, in the first 6 months, if you see, the focus states has given us SSG of 13%, whereas the focus state has given SSG of 10%. The focus states are doing very well this year across the zones. So I think in terms of numbers, the numbers that we have planned, we are on track to achieve that number.
Okay. And what will be the guidance for the next 2 years in terms of sales per square feet, in terms of percentage growth, if we are any targeting, and what is the normalized SSSG that you would like to target for next 3 to 4 years?
So in terms of revenue, I have told on my previous call also that I would like to start the year with a 25% revenue structure, and as the year go, if there is an increase, we would change the guidance, but the business plan will be created on the 25% revenue growth with the SSG of again 6 to 7%. So that will be the structured planned way to go ahead, and for the next 2 years at least. Post that depends on the strategies that the company adopts to open more stores.
Yeah. Thank you for the clarification. Thank you and good luck.
Thank you.
Thank you. The next question is from the line of Arman from Blue Sky Fintech. Please go ahead.
First of all, congratulations on good set of numbers. Just reiterating on the guidance part, because like if we take this into 30% account also, that means we are aiming for a growth of just.
Sorry to interrupt, Arman.
Hello.
Can you please speak a little louder?
Hello, yeah. Is it better? Hello.
Hello.
Hello. Yeah, is it better?
Hello. Yeah, now it's better.
Yeah, just reiterating on the guidance part, sir. Because if we take into account 30%, that means for H2 we are targeting just around 10 to 11% of growth, and already we are seeing October month getting good traction. Then are we really very conservative over here? Just on that front, I want to have an understanding from you.
So see, I think as a business, we plan quarter and quarter. As I said that this quarter looks good to us, and with the winter being the biggest, I think, product portfolio that sells in the month of November and December. But winter is very unpredictable in terms of sometimes now it looks good, and we have seen over the years sometimes the climate changes suddenly, which leads to a drop of sale also. So I think the way we see this 30% guidance is more on the current structure, and I think with this quarter going on, how this quarter spends up after December, then again we will be able to take a call. But on a interest of, I think, everyone, whether it's a stakeholder or the company, we believe in conservative approach. So we would like to right now stick with 30% guidance only, and I think after seeing this quarter, then we can come again next call.
Okay. And so my second question is, like we already told that we have a little bit of concentration, comparatively more concentration on West Bengal and Assam, and that's why our numbers are a bit skewed compared to other players. So when are we going to see that going to stabilize? I mean, in which financial year we are going to see that will be be on par with the industry players?
So to be very frank, I don't have an answer right now on that question. The reason is that though we are opening stores in all the geographies, so what happens is that the Bengal has a very high concentration of sales coming right now because of a lot of stores getting open in the metro and tier. So I think that is a good point. I don't find it as a challenge. I think if I'm able to achieve a good profitability, that's good for the company that way. In terms of revenue, yeah, as we are growing more on the focus states, so the balance will come, but not before I think FY27 or by end of FY28, because that many number of store has to be opened in those geographies which are more focused on like UP, Bihar and Jharkhand to cover up the sales of Bengal, because Bengal as a state also has a higher sales per square feet for us, because there are a lot of stores in cities, Kolkata itself. So we have got very high basis from Bengal coming in. So I think it will take at least FY28, I will say, to get things to get settled in terms of revenue contribution coming from both Bengal, Assam and other states put together.
Okay. Thanks a lot. That's all from my side. Thank you.
Thank you. The next question is from the line of Gaurav Jagani from JM Financial. Please go ahead.
Hi. Thank you for taking my question again. I just have one question. If we add up the depreciation number only for the H1, and assuming that the Q2 number kind of stays, the depreciation for the entire year could be somewhere around 160 crores versus 100 crores last year. So the depreciation in the reported terms will see a sharp jump. Is that a right understanding?
Just a second, Gaurav.
Gaurav, to discuss this, we will take this offline. We can.
Yeah. No. That's all from me, sir. That's it.
Thank you.
Thank you. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Thank you for the opportunity again, sir. Sir, despite of large chunk of your stores being in Bengal, West Bengal and Pujo being preponed, your difference between your actual SSSG and normalized SSSG is very low. So what could be the reason for this?
So see, in terms of, because there is word of normalized SSG just started from this April itself. If you believe, we never used to report this. The only idea is the way we calculate the normalized SSG is that the period which is going in both the quarters. So for example, this year 11 days has been shipped from last year October to this year September. So in terms of for the calculation of this normalized SSG, we have taken from a period from 1st July to maybe 19th of September of the last year also. So we have just shifted. So that is a normal period without that festival shift that we have given in terms of SSG.
So even despite of that, the growth SSSG was 19%. So that is encouraging. Okay. Thank you, sir. That's it from my side. Yeah.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Achut Prabhat, an individual investor. Please go ahead.
Yeah, hello. Am I audible?
Yeah, you are audible.
Yeah. I just wanted to know what is the growth guidance for FY27?
So see, as of now, as I said, we aspire to grow by 25% every year. That is our aspiration. I have told previously in previous calls also. So that will be the number that will benchmark for the growth purpose.
Okay. And one more question, like the profit after tax guidance of 3 to 4% is excluding the exceptional income we got in this quarter, right?
Can you just come again? And your voice is not audible.
I mean, we got exceptional income of 50 crores this quarter, right? So the PAT guidance of 3 to 4%, it is excluding the 50 crores income we got in this quarter, right?
So PAT guidance for Pre-Ind AS is 3 to 4, and without this exceptional gain, which happens to be on the Ind AS side, is 2 to 3% without exceptional gain.
Okay. Yeah. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, this is the last question for today. I now hand the conference over to Mr. Shreyan Shurana for closing comments. Thank you, and over to you, sir.
So, thank you for joining this call. We'll love to see you in the next call. Thank you.
Thank you, sir. On behalf of Bazaar Style Retail Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.